Good afternoon, everybody. Thanks very much for joining us. My name's Richard Betts. I'm the publisher at Real Asset Media. One of the key things that we wanted to pick up here was just a kind of outlook on the market, how we see the UK, and where we head for this. As I said, this was originally going to be at Expo Real. Personally, it's a shame that we can't be there. I was looking forward to being in Munich today in order to host this as part of the Hybrid Summit. And I would like to say thanks to Claudia Boymans and the whole team at Expo Real for organising a fantastic programme, and I'm very pleased that we're able to support that just by at least holding the two sessions that I was going to be moderating. So thanks very much for joining us. One key area that I just wanted to pick up on was that this is part of a series of initiatives that we've created during this time, both Realcast, but also events. We're running 60 plus events, special reports, and also RealX.global, which was a virtual exhibition and conference that we launched. And the idea of that is that it's a permanent exhibition, which helps connect people, and also helps create the contact that in some ways is missing at the moment in the industry. So do feel free to visit the exhibition after this session. You can just go to realx.global and visit that, and just click on the exhibition here within the session that you're looking at the moment. But what I'd like to do now is just introduce the panel. So we've got a super panel here. We've got Mark Hayward, who's a partner at CMS. We've got Stephanie McMahon, who's head of research at BNP Paribas Real Estate. And we've got Tony Brown, who's global head of real estate at M&G Real Estate. So if you could just put your cameras on, that would be great. And maybe let's just start with some introductions. Steph, why don't we start with you? Just give a kind of brief introduction of yourself and the company. Thanks.
Thank you, Richard. Hello, everybody. So Stephanie McMahon, I head up the research team at BNP Paribas Real Estate in the UK. We're a global full-service agency, and we belong to BNP Paribas Bank, the fifth largest bank in the world, where we have wealth management, retail banking and investment banking. So on the research side, I've worked in research now for 20 years or so, and my real focus is on the demand side. So how do we expect the demand for real estate to change and evolve? So really my passion, if you like, is looking at changes in behavior. So my team and I, we look across all asset types, so that's commercial, residential and rural, which I think gives a real sort of oversight as to what money wants to get into and how we see demand evolving.
That's great. Thanks very much. Tony.
Yeah, thank you, Richard, and afternoon, everybody. So just by way of background, M&G Real Estate is part of M&G PLC, which is a FTSE listed savings and investment business. And the real estate division, which I'm responsible for, is managing just over £30 billion of real estate assets. The UK is our home market, it's our biggest market, but we also invest in 29 countries around the world on behalf of a wide range of largely institutional clients from around the world, but also in the UK on behalf of wholesale clients as well.
Now, Mark, we seem to have lost your camera, but can we hear you? That's the question. Can you hear us?
Hopefully, Richard. Can you hear me?
I can. Perfect. I'm sure your camera will come back in a second. But while it does, just give a brief introduction of yourself and CMS.
Absolutely. Well, I'm Mark Hayward. I'm a partner in the law firm CMS. By day, real estate is my speciality. I also have a management role, including responsibility for our out of London offices in the UK. CMS in the UK was bolstered by the 2017 merger with law firms Olswang and Nabarro. Nabarro, of course, famous in real estate, and I was one of the Nabarro cohort. Globally, we have, at the last count, 80 offices in 40 countries. 68 of those offices have real estate representation, so a decent footprint to contribute to this debate.
Steph, why don't we start with you? Just in terms of, I suppose, for the UK, how do you see the current market position?
Okay, I mean, I think we've got a very mixed market position, as you might expect at the moment. And when I look at the teams across my business, for example, we can see that the valuers are very busy. The ratings and professional surveyors, again, very busy. Our prop man, etc. But we do have clearly more challenges on the market side, and particularly outside of industrial. The alternatives are holding up predominantly pretty well, but in overall volumes, I think we see UK volumes, capital markets transaction volumes will be about 40% down this year, and I think that really kind of exemplifies where life is at the moment. And that is also, it's not just capital markets, but also occupier activities. So if we're looking at the kind of more negative end of the spectrum, or the quieter end of the market, central London offices, for example, take up is significantly down on the same period last year. And we haven't finally got our numbers fully signed off, but we're about 70% down take up on the same period last year. So although the year to date, the overall year to the end won't be as dramatic as that, I don't think, it does give you an idea of how quiet life is. But on the other hand, industrial's strongest year take up ever. So it's really a very, very interesting market.
And Tony, I suppose because obviously M&G real estate is across several geographies. So I suppose, how are you seeing the UK, particularly looking at that kind of more global pan-European perspective?
I agree with Steph in terms of the current environment is quite polarised in the UK. But I think you can say in general terms, the investment market would be classified as risk off. And I think that's actually true on most markets around the world. Where that kind of comes through is that the definition of kind of low risk core assets has been more closely defined now than it would have been maybe last year. And therefore any asset that has a little bit of risk to it, whether it's location or tenancy or physical structure, now it's kind of a narrower definition of what we regard as a low risk asset than before. And that always tends to happen when markets move into a more risk off type environment. But I think that the big difference at the moment between the UK and, say, continental Europe, and in particular Germany and France as the two main markets, is that in Germany in particular, because of the amount of domestic capital, the German open-ended funds in particular have got so much capital at the moment. The investment volumes in Germany this year are probably actually going to be up on 2019, as amazing as that might seem, given everything that's going on. There are probably going to be higher investment volumes in Germany. And even in France, where obviously most of the activity is focused on Paris, we've actually seen recently record yields being paid, for example, for the Adidas headquarters in Paris, yield of 2 and a bit %, which is a record for Paris CBD. So that kind of contrasts to the UK, where, as Stephanie has said, there's a lot less investment demand at the moment, and also pricing is quite different. Pricing going into this pandemic was quite different anyway. London, for example, on a yield basis was much cheaper than places like Paris or Frankfurt or Munich. But in a way, the yields in places like Paris and the German cities have hardened, and the yields probably in London and other UK cities have probably remained reasonably about where they were for the most prime assets, but have started to drift out for less prime assets. So there is quite a big difference, I would say, not only within the UK, but also the UK compared to maybe its continental peers.
Okay, good. And I'm going to come up to pick up some of those points in a minute. Mark, I just wanted to pick up with you, because obviously you're joining us from Manchester. So I just wanted to pick up a little bit on, I suppose, what you're seeing in terms of the interest, picking up a little bit around the capital side. What are you seeing in terms of the interest more broadly for UK markets, but also picking up a little bit on that regional side?
Well, I think we see a very disaggregated market, which I think Steph has highlighted. A lot of what is on our desks at the sharp end is industrial. The likes of deals for and opposite, the Mount Parks, Tristans, Richardsons, Panattoni, yields that are sub 4%, lot sizes, anything from 50 to 500, 600, 700 million. And we're seeing that across Europe, frankly. So that industrial sector is very strong. I think the next in order priority would be what I think people are increasingly calling the living sectors. And certainly regionally, we see a lot of that as well. And by that, I talk to healthcare, so the likes of Assura and PHP, Active, student, really strong, despite the lockdown and all the noise around students. I think people believe in that sector. Here in Manchester, Vita sold their platform, and we helped with that to DWS last year, very big, high-profile deal. We're also seeing an awful lot of regional, what I used to call, I'm old enough to call Resi, but I think these days is PRS or BTR or whatever acronym you prefer. But we've seen a vast amount of that. I mean, famously, the likes in Manchester of Renica with 4 64-storey towers, 1,500 apartments, but also the likes of DTZ Co-Living Fund in Earlsfield, Long Harbour Multi-Income Fund, Tottenham Hale, so that is what we're seeing. So perhaps not so different from what the other panelists are talking about. Obviously, investment volumes down. Steph mentioned 40% year on year. We're hearing 35% against the 10-year average, but a very disaggregated world. And I think we'll probably come on to talk about it, but regionally, what has also been important is government covenant support for long lease annuity product. But I no doubt will come on to talk about that.
Yeah, I think that's a really interesting point, Mark, and I definitely do want to explore a little bit also those areas of what the government initiatives have been in terms of the response to the crisis, and also maybe some of the ones in terms of how we see the Brexit negotiations and things that we can all, as opposed to guessing, the things that we can already kind of see. I just wanted to explore the capital side a little bit, though. Tony, just coming to you. I mean, I had a session on France last week, for example, where some of the investors were particularly focused on the domestic capital side and seeing more opportunities within France, and because of the absence of some of the international capital. I suppose, what are you seeing, given that, from both sides of the fence, given that you're also investing outside of the UK, but inside the UK as well? So I suppose, how are you seeing that at the moment?
I think you can't underestimate the practical limitations of just travel restrictions around the world at the moment, because obviously normally investors and advisors will be traveling to different countries to look at underwriting of assets for acquisition. And just the reality is at the moment, people just can't do that. So I think there's a practical element to this, which is almost irrespective of kind of the appetite for risk across markets. So I think that is having quite a dampening effect on international cross-border investment, maybe a bit less so within the EU, because it's a bit easier to travel around the EU than maybe it is elsewhere. But certainly for the UK, we're seeing a lot less international investor demand for assets. And I think for a business like ours, where we're representing money both domestically and internationally, it actually presents quite a good opportunity in some ways to acquire assets with less competition than there would have been maybe a year ago. And we've actually been quite proactive over the last few months in doing that. For example, buying an office building in London recently on behalf of Asian clients. And so I think it's the pricing of that particular deal is probably roughly where it would have been a year ago, but we probably wouldn't have been able to buy it a year ago, because we would have had more competition, and the vendor would have had greater choice of who to sell it to. So I think there's definitely less international demand. Whether that's because of the appetite for risk and the kind of general sentiment towards real estate is difficult to tell, really, because these travel restrictions just override it. Even if you really wanted to go somewhere and invest in it, just practically it's almost impossible at the moment. So I think it's a bit difficult to know whether, for example, the UK is having any impact because Brexit still isn't done, or whether it's just because of the practical limitations on travel. I think it's difficult to say, but the reality is there's limited cross-border capital at the moment. Certainly coming into the UK, that's definitely true.
Yes, Steph, go ahead. Yeah.
Thank you. Because it is a really interesting point, isn't it, to sort of think about what is risk and what is just inaccessibility. And if I kind of back to the demand point, because that's obviously the area where I'm keenest, is we did some very top level survey work across our portfolio across Europe to see what occupancy levels were like, and there is a huge disparity. You know, we have in Germany at the moment, we have pretty much 100% occupancy in our buildings versus, say, in Spain, where we have about 33% occupancy in our buildings, and London has its own big challenges around public transport. So if you're looking at kind of the income risk, that gives you sort of a real feel, doesn't it, for which countries look like they have returned to some sort of level of normality in their office space particularly. And I think tracking these sorts of metrics is going to give us a real flavour for how different territories are looking in terms of their risk profile.
That demand side, and this is a question to anybody really. I mean, obviously, there's been a lot of focus on the health crisis and what that's meant, but then we've got potentially a large recession coming up. Do you think investors at the moment are mainly looking at the UK, thinking, okay, well, there's Brexit? Do you think they're looking at the analysis to say, well, this is the amount of money that's being spent, this is how we see a recovery from it? I mean, it's interesting, Mark. I think you were seeing some interesting views in terms of capital and their views on Brexit and the fundamentals in a way.
Well, at the risk of being a little bit contentious, I mean, what we've heard for some time from Singaporeans, from Malaysia, from China, and in fact from North America, has been that the Brexit debate is not new. You know, 23rd June 2016 was the fateful day, and that that particular risk and happening has become institutionalised, priced in, if you will, and also viewed, which I think is quite interesting because it stirs such emotions, and it's important to us as to whether we're regarded as Europeans or not. But actually, from afar, the view is much more around it looking like a boundary dispute or neighbours squabbling. The view is that it doesn't go to the absolute fundamentals of demand, certainty, rule of law, stable government. So if you are looking at a pan-European logistics portfolio, for example, Brexit doesn't appear to be particularly high on the list as compared with, you know, EU sites and service yards, for example. So I don't think we're finding that Brexit plays particularly strongly. I think what is really interesting, and of course we would all struggle to answer this, is the size of the economic, cultural and social bill that is being amassed. And I did notice with some interest this morning the ASOS results. You know, tremendous on the face of it, 20% up, profits quadrupled, but the share price dipped, and a little bit of a bittersweet commentary about consumer disposable income and the ability to spend online going forward. So that, I think, is exercising, from what I see, the markets far more than the Brexit debate, but others may have a different perception.
Well, let's drill down into that a little bit. I mean, Steph, what's your kind of view when looking at how much some of these things are going to impact on the real estate fundamentals?
If I kind of go to my colleagues at the bank at the moment and we look at our economic forecast coming out of there, then we are certainly looking at more downside risk than we were 3 months ago, for example. So as we head into this, you know, 3-tier situation that we have at the moment, where there's going to be clearly a huge amount of uncertainty as to how people are going to be able to shop and move around, etc. The retail footfall figures actually haven't been bad. They've been quite positive, the latest round, but you know, we can anticipate that that's going to decline, particularly with more lockdowns coming. So I think overall economically, what we might have seen as we still see the swoosh or whatever you want to call it, but it's more shallow than it was. It's going to be a longer one than it was previously. So clearly that so much now hinges on what happens with unemployment. I mean, the real economy tends to sit, doesn't it, behind, you know, a lot of the kind of market activity by about a year. So as we go into Q1, Q2 next year, those unemployment levels are going to be absolutely pivotal. And the level of support that the government is pushing into the economy, that can't continue forever. So I think the consumer sentiment is going to be absolutely sat around that. Now, one of the other big indicators of what tends to make people feel confident or otherwise is their how secure they feel in their homes. We are unlikely to be looking at significant hikes in interest rates anytime soon. So that is one thing, but then that you have to kind of balance that out with the rental market as well. So I think it's going to be very tricky, and I think that consumer sentiment is going to decline. It's already looking it's already wavering, so it's going to get worse. And then the knock-on impact for the retailers, as you say, ASOS has come in very strongly, but if you're doing physical retail and online, can you make a profit around your deliveries? Are you able to run the store profitably as well? And I think we're going to see more of this kind of come out under the woodwork.
Tony, what's your? I mean, you're obviously having to think about asset allocation. What does that mean for you when you're looking at that? I mean, I suppose how are you judging that in terms of the sort of macro picture and how that's going to influence your investment decisions?
Yeah, I mean, I think what we've seen so far amongst our clients, most of our clients are largely pension funds and investors who are investing internationally in real estate, and it's been interesting so far that most clients have either retained their allocations to real estate as they were pre-COVID, or in some cases actually have increased in certain areas, but generally it's stayed about the same. And I think that the reason for that is that at the moment, in terms of real estate, there's in some sectors, in particular, say retail and hospitality, there's a cash flow crisis. So you just can't get any rent. We can't get the normal rent that you'd expect to achieve from an asset. And that's not good, obviously, but I think the expectation is that's relatively short term and a temporary kind of abatement of income to some degree. Now, obviously, that depends how long that goes on for, because I think at the moment, most of our clients are relatively sanguine about that because they're investing for real estate for the long term. So if there's a temporary suspension of some rent collection, then they can kind of live with that to some degree. But also, if that goes on, for a long period of time, then attitudes towards real estate investment might turn more negative, and that's quite possible. And the reason I say that is because the real attraction that real estate has for most investors is the level of income compared to other asset classes. In fixed income and fixed interest, yields are virtually nothing, and sometimes are negative. So real estate does provide a relatively attractive income return to investors that you can't really achieve anywhere else. So that's why I think investors are sticking with real estate, because real estate is a risk asset. But if the income is achievable, then it's probably fine. And obviously, as long as interest rates remain low, which they'll probably be lower for not only for longer, but almost forever, it feels like, then that's quite a good situation for real estate on a relative basis. But if rents continue to be unpaid for a prolonged period of time, that might start influencing investors' decisions about whether the risk premium for real estate is appropriate or not. At the moment, there's no sign of that changing, but it could do. If rental payments become impaired for a significant period of time, that's the biggest risk, I think, at the moment around allocations to real estate.
And Mark, you mentioned it earlier at the beginning there around the some of the UK government projects, infrastructure spending, those kinds of things. How do you see that at the moment in terms of either supporting or not supporting, I guess, the real estate side?
Well, as Tony will know, I mean, a particularly attractive product and feature, certainly of the out of London UK market for the pension funds, has been government supported covenant, whether that's expressed in the form of income strip, lease commitment, grant funding, howsoever meeting that perceived viability challenge or shortfall. And that's expressed itself in many schemes across many regions, whether it be the Embankment Office scheme in Manchester, the entire redevelopment by Muse, say, of Blackpool through Talbot Gateway, schemes brought to market by U&I or the Far East Consortium's investment in Northern Gateway. These are schemes which are all underpinned to some extent by some mix of income strip, covenant, prudential borrowing, as it's so called, or old-fashioned grant funding, whether through building better futures, the HIF, Housing Infrastructure Fund, our old friend, so-called Evergreen. So I think the question that we're wrestling with is whether the government desire to prompt economic activity will see that continue, if not enhanced, or whether the purse strings, being under the pressure that they're under, will be drawn such that we don't see that product featuring. And I guess be interested in the other panelists' view on that, because it has been a real feature of the market and an opportunity for the pension funds in particular to match kind of liabilities and inflows over what would typically be a 30, 40-year term with an index guaranteed, capped and collared income courtesy of the government, in essence. So interesting to know how others might see that. It's certainly something that's exercising us at the moment.
Maybe Richard, if I can come in on that.
Yeah,
So we've been quite successful in that field for a number of years now, and what Mark says is right in the sense that a large number of pension funds really crave inflation-linked cash flows over relatively long periods of time. And so, for example, we've funded civic regenerations in the north of England and northeast of England in areas where the actual underlying economic activity is quite low and quite poor, but we're able to fund it through, for example, income strips where the local authority might take a 35, 40-year lease, and they'll pay back to the pension fund with an inflation-linked cash flow over that period. And at the end of the lease, the property goes back to the local authority or the government body. And so all the pension fund is basically getting is an inflation-linked cash flow for a prolonged period of time. But there's plenty of demand for that in the private sector. And I think it's going to be interesting to see how much of that demand meets the political agenda around levelling up, which has been obviously quite well trailed by the current government. Mm-hmm. In reality, there's going to be a need for lots of private finance to support the levelling up agenda, particularly around regeneration of areas of low economic activity. And I certainly believe in a world of low interest rates, the private finance is going to be available for it. The structures that goes through and where that capital ends up being placed, I think, is still open for debate. But certainly, we're there ready with our clients, for those types of products. And we have kind of, I wouldn't say we've got insatiable demand, but we've got huge demand still from domestic pension funds for that type of product, if we can get the structures put together with government bodies. So I think we could see a lot of that. It could be quite important over the next few years.
I agree with that, but without getting too technical, Tony, I'd be interested in your view. I suppose the challenge will be that the gap is potentially going to get wider, because when you buy an income strip, I know that responsible, reputable UK pension funds do like to understand the underlying rental income piece and the profit rent gap and all that other good stuff. And I guess if the underlying economics weaken still further, it becomes a bigger gap to fill. So that, I guess, is another element.
I think traditionally that would be the case, but I think if the underlying cash flow is secure, and all really matters is whether the underlying cash flow, which in the case of, say, a local authority regeneration would be, whether the local authority is going to pay you back over 40 years or not. If the local authority, cash flow is secure to pay you as the pension fund, then almost the underlying real estate is, I wouldn't say it's irrelevant, but if you're handing the asset back to the government body at the end of the lease anyway, the whole question about residual value that exists normally in real estate doesn't really exist, and it becomes much more of a quasi fixed income type product where the underlying asset could be on almost anything really. So I think that's where the opportunity is, because for us as a business, we would struggle to take economic risk in an area where economic activity is really low, and taking a risk-adjusted approach probably wouldn't make any sense. But if it's based on the covenant of the public body who's paying you back over 40 years, then it takes a lot of the discussion around the underlying economic risk out of the equation, and therefore the pricing that you can go for these assets at is much more attractive to the public body than it would be if you're taking economic risk. So that's the key to it, really. I'm not saying the underlying asset is irrelevant, but it's much less important if the covenant of the cash flow is secure for you as an investor.
I wanted to pick up the point actually around the levelling up, because it's good that we've got you sitting there in Manchester, Mark, and I've obviously been doing a lot with the Scottish cities and things like that. So it's been interesting to look at both London as well as regional cities. Steph, I suppose, what's your sense of that at the moment? Do you see either what's happening at the moment as a kind of potential advantage, whether or not there may be more office development in regional cities because of the health crisis, or not because of the health crisis, but as a kind of influence from it? I suppose, how do you see that at the moment, that sort of future of London as a major city alongside the other regional cities?
So actually, we started a piece of work about a year ago looking at some different KPIs to kind of measure future city resilience, and the timing's been quite worked out sort of quite ironically quite well in some respects, because we were looking at things like environment and community and well-being and tech scores and the like. And what's kind of interesting to me at the moment is understanding which locations are really going to appeal to people on a lifestyle basis, and then how close are those to areas that can provide sufficient economic stimulus and also scale. Because I could sit here and say, well, Exeter's a fantastic city to live, and or Worthing, or a number of these different locations, which are actually, they have great levels of community when you measure them and looking at different KPIs. But whether the equivalent of a peer of Tony's or similar would then have the scale to invest in that, or on a large scale, is really debatable. So for me, it's actually looking at almost the hinterland lifestyle locations, and then whether that is sufficient to attract the talent that will then really support that local labour market. And I think if we have an estate agency business, looking at that at the moment, the numbers of people that are perhaps taking a decision that they might not have taken previously and saying, actually, I'm going to make a bit of a lifestyle change here is huge. Now, whether that continues ad infinitum I think is debatable, but there appears to be a movement at the moment that would indicate that there's an opportunity to level up. But that, to Tony's point, and I think to Mark's point as well, that is going to be reliant on a location being able to support that economic growth in itself, and also the local authority being able to underpin it. London, I mean, personally, I fully believe in London. I think London's massive benefit has been its public transport, which at the moment is its massive disbenefit. But that's not going to last. That's not going to last forever. That's something that is going to change. So I think we've always looked at very traditional metrics around why to invest in places, why to develop in places. And maybe we need to look a bit more broadly at that now and bring in some of these other metrics around what really is going to make a place successful.
And is that something that you're now having to look at and sort of review, Tony, if not maybe reimagine, but beginning to look at those things and say, okay, well, I mean, we'll tackle the sectors in a moment, but say, beginning to look at, well, are there going to be some changes? Well, let's do office now. let's just do it now. Are there going to be some changes in the office market? How do you see that? How do you factor those into kind of your views on investment?
Yeah, I suppose when you think about real estate investment, one of the advantages of doing it is that you typically invest for relatively long periods of time. It's obviously too expensive to switch in and out of real estate on a regular basis. So you kind of have to have a view to the future, and you have to understand structural themes that may affect how people live their lives, or where they work, or where they shop, and what have you. So I think you can't ignore structural trends. And obviously every now and again something comes along which certainly when you're in the thick of it appears to either change people's perceptions of value, change people's perceptions of how they live their lives. Often, though, I think history probably dictates that we probably overestimate the immediate impact of some of these things, but possibly underestimate the long-term impact when you're in the kind of thick of it, as we are now with the COVID crisis. I mean, my view on the office market is relatively simple in the sense that I think there's no question. I mean, Stephanie talked about this at the start. Is that in the short term, actual demand for use of offices is likely to be a lot less at the moment that we would have expected. And that's probably going to remain the way, certainly in the short term, until we get to some level of normal economic activity rebounding. Because if you're an occupier at the moment, obviously everything's uncertain. So are you going to take new office space to expand? Probably not, unless you really have to. And that's an obvious thing that business would decide to do. So in aggregate, there's probably going to be a bit less demand, probably for the next couple of years while things sort themselves out. But I think beyond that, I still fundamentally believe that people will need to work in offices. And it depends who you speak to. Everyone's got a slightly different perspective on working from home. And it's sometimes quite easy to kind of overlay your own experience of it and assume that everyone thinks the same, but in reality they don't. Whatever demographic you're from, what age group you're from, also what country you're from and what the culture in that country is. Some cultures around the world, like Japan, have a much stronger presenteeism culture. Germany is much more presenteeism culture than, say, the UK would be. So these things you have to kind of overlay in terms of what the long-term impacts might be from country to country, when it comes to the impact of working from home. But I think in reality, what we'll probably see is that occupiers will be much more discerning about the office space that they take, because their staff will be much more discerning. The staff will be saying, what is the level of clean air that's provided? Does that building have a wellness certificate? What is the amenity in the building? How well located is it in relation to transport, et cetera, et cetera? And these things have always been considerations in the past. What are the environmental performance and metrics look like in that building? So I think that probably the conversation is probably going to change a bit, and those people who own office buildings that can't meet that kind of occupier demand are probably going to lose out, and those who can will do well. And that's the way we look at it, is probably looking at being much more discerning about the way in which we invest in offices, because the occupiers will be more discerning going forward. But I think in reality, a lot of CBD locations, a lot of central cities, we've already seen a conversion to residential and to some extent hotels, and a lot of CBDs around the world. This is not just a UK thing, it's not just a London thing. Anywhere you go around the world, compared to 15 years ago, there's a huge amount more of people living in city centres. There's a lot more hotels than there were. So in the same way that we've seen conversion of office buildings for alternative uses, I think that's likely to continue. Maybe not for hotels for a while, until the hotel trade picks back up again. But we'll probably see a slight shrinking in the level of stock that's provided for offices. It's more the tertiary locations and tertiary buildings get taken out for alternative use. I think that's likely to continue to happen as well. But certainly as a place for collaboration, for promoting a brand, offices, physical office is definitely, in my view, a place where people are still going to want to be in the future.
To add to that, if I may, Richard, I fully agree. I think in many respects the office almost becomes more important. Do you need quite the same amount of space? Perhaps not, and that will play out over the next couple of years, and we'll get a real feel for what future corporate space needs are. But the world has changed. Even a year ago, there was that article in the FT about the air quality on the Central Line, for example, which made a lot of people really question their commute. And if you can walk into a building and use your smartwatch or your phone, and it will tell you immediately what the air quality is, that is going to alter how you view a place. But I am working from home at the moment. I mean, our audience won't be aware of this, but just prior to this call, I had to run around to my neighbour's house carrying 2 laptops and a phone and a cable, because my Wi-Fi is gone, my broadband's broken, and it's not conducive to all levels of work. And I mean, so I think I totally agree. We're having a bit of a reaction, but how that works out in the long run, I think we'd quite like to collaborate together.
And I'd like to pass on our thanks also to your neighbour, Steph, as well, for enabling that. Mark, what's your sense of it? Because obviously CMS there have a big office in London, but obviously have a substantial office there in Manchester, which you are in. Are you seeing any kind of movement in terms of, I guess, more larger scale employers moving towards the regional cities? And feel free to use Manchester as an example if that's the most simple.
Well, sure. I mean, I think 2 observations really. I think the first generic observation, I couldn't agree more. We're in violent agreement with what previous speakers have said about the office. I've been surprised that far from the death of the office, some of this experience has been really under reinforcing the resilience of the office. Particularly our younger people talk about the community, the infrastructure, the training, the supervision, the well-being, the mentoring that comes with having a focus or a hub. And as a provider of professional services, if I was being entirely kind of irresponsible and speculative, I wouldn't be surprised if we've accelerated a change to say 3 days a week in the office, 2 out, just for the sake of plucking a number from midair. And that, of course, will have tectonic change and shift in terms of space requirements, but it's not the death of the office. And I also would reinforce the comments. We did a major piece of thought leadership. We'd be happy to share for those who haven't seen it. And it really brought out the ESG agenda, the importance to people of the right kind of office space with the right sustainability, environmental and other package. I think in terms of the question you asked about a drift to the regions, I did see an Evening Standard headline before any of this began that talked about the drift from London for the first time ever, 25 to 34-year-olds leaving the capital. I think there's an element of push and pull. And by the way, I'm a huge fan of London for GB PLC and lived and worked for 12 years myself in the city. But I think it has become more difficult to live there, to have your modest terrace in the Nightingale Triangle that's now probably 1.5 million or whatever it is, to travel, to have a quality of life. There is a bit of a push, I think, for those who are on what we might call modest or standard. I think it's become harder. And I think there's been a bit of a pull because I think the regions are no longer the kind of Thatcherite, if I put it this way, giving away my age, the sort of Joy Division Smiths apocalyptic boys from the black stuff. We've had so much investment and so much success that the regions are much more attractive. And I think you will struggle ultimately to get away from the economics of floor space that's half as expensive, maybe £30 a foot as opposed to 60, when you have got lots of good available talent. But again, important not to overstate it. I mean, in Manchester, we've seen the likes of Amazon move in, 600 people, talk, lots of examples. So I think there is that trend, but I wouldn't want to overstate it.
I wanted to explore the other sectors as well. Obviously, a huge amount of interest in logistics. What's the position here in the UK in terms of logistics? I mean, Mark already mentioned that in his view, from his perception of investors, they were less worried about logistics and more about the fundamentals of e-commerce and the economy. Steph or Tony, I don't know if you want to pick up your kind of house views on logistics, really, particularly for the UK.
Yeah, I mean, sure. It's been in the maybe I'll go first. It's an incredibly hot market at the moment. Probably the hottest it's ever been. I think probably what was it 2-3 years ago when Amazon were by far the biggest occupier or of demand out there, and I remember thinking at the time, oh well, actually that's interesting. They're obviously rejigging their supply chain, and that'll be them quiet for a little while. 2 years later, they are again the biggest occupier out there, and they're taking vast amounts of space. And I just the supply chains are evolving all the time. And as I think it was Tony that said earlier, real estate is not a quick business. You don't build, shift and move on and change your real estate very rapidly. So these supply chains, they take time to work through. So I mean, I think there's just that demand is going to continue, and it really is incredibly hot at the moment.
And how does that play in to retail for you as well? I mean, obviously we've got the rise in e-commerce, and everybody at the moment is very down on retail. But what's your sense of that?
I think it's worth looking at assets and whether they can be repurposed, isn't it? And whether those retail assets can be either partially or fully utilised for other reasons, whether that's retail or something else. So the most, for me, then it kind of looks at flexibility. So what are the most flexible retail assets and that can be changed quite quickly? So perhaps some of the parks that have got very high levels of apparel at the moment would be feeling a bit vulnerable, but whether more of that stock could be moved into delivery or storage or similar. So we're going to have to be very flexible about how we look at retail, because retail is clearly having a lot of challenges, and that's not going to change. Physical retail, that's not changing. It's just going to increase in those centres that are already declining, in my view.
Tony, what's your view? I mean, let's pick up the logistics and the retail discussion there.
Yeah, I mean, the reality is that the UK has the highest penetration rates of any country in the world for online retailing. I think only South Korea gets anywhere close to the UK, and that's just gone accelerated through the last few months. I think that this year, 25% of all retail sales are online, and that's grown, I think, from about 20% last year, and it was probably about 7.5% 10 years ago. So it's an incredibly steep rise in the way people changing the way they shop, and it's because the UK is perfect for online retailing. There's a lot of people in quite big cities living in close proximity to each other, and so it's almost a perfect environment for online retailing to grow, and that's one of the reasons why it has grown so much over recent years. So I think that you have to accept investing in real estate that there's definitely now a profound change in investor sentiment, switching from retail as a negative to logistics, which is a positive, and that just reflects structural changes in society about how people purchase goods. I think that has to be reflected in the way you invest in real estate. I mean, in retail's defence, what I would say though is that obviously the growth in online retailing is not a new thing, and so this has been around for 20 years, and so we've all had time to think about this. And pricing of retail, certainly over the last 3 or 4 years, both in rents and in yields, has moved out significantly. Whereas at the same time, logistics has gone completely the other way. And that's probably right in terms of the level of demand that exists. But there will come a point where certain types of retail would look on a relative value basis attractive, particularly for those who are prepared to take a bit more risk. But I think ultimately it comes down to getting the rents right. And there's probably still a bit further to go in most retail locations in terms of rents. But also, as Steph says, about repurposing. And I think that we've already seen examples of that. So the Toys R Us store in Purley Way in South London has now been converted to an Amazon logistics warehouse. Westfield in London are talking about their shopping centre, the upper floors of the House of Fraser being converted to offices. Now that's all fine in South London, in Croydon, or in the West End of London, where there's high economic value. I think the real problem lies is in parts of the UK where there's low underlying economic demand, and the switch to alternative use, whether it's resi, logistics, or anything else, becomes much more difficult because there aren't the economic drivers that are behind it. So the real problem for retail is going to exist in areas of low economic demand, and that's, for my mind, is the biggest issue, because repurposing or finding alternative land uses, which ultimately the real estate industry will always do, is going to take a lot longer in areas where there's frankly less choice to change things, and to my mind that's where the biggest problem lies.
And I think resi's been kind of put up as the panacea for all ills, hasn't it? That where we can convert it to residential, but that's not necessarily the case either.
Yeah, I mean, resi demand will depend on on the economic environment of that location and the availability of jobs and everything else. And so if you've got a shopping location where there's maybe high unemployment or low economic demand, then resi doesn't really become an option. That's where often the public sector is going to have to step in around regeneration, and a bit to the earlier discussion about levelling up and that sort of thing. I think it's going to become, over the next decade, that's going to become a huge issue in the UK, and one which will need to be tackled.
And I'm conscious we've only got kind of 10 minutes left, but just in terms of some of the other sectors, obviously things like healthcare, senior living also came very much into focus because of the health crisis, life sciences. How do you see, I suppose, those particularly in the UK? Do you see those niche sectors, I guess, developing further in terms of investor appetite and opportunity?
I think healthcare has been it's been incredibly challenging, let's face it, operating in the care sector over the last few months. And I think actually the care sector has done a phenomenal job in managing infection control in those circumstances. For me, what comes out of that one of my other hats is I sit on the ULI Resi Council, and we wrote the ULI Housing with Care guide, which we published a year ago, nearly almost. And the real estate is phenomenally important in that sector, but this has really highlighted how important it is in terms of infection control and managing and operating healthcare spaces. And I think that's a fascinating area to watch, because some of that real estate is just not going to be fit for purpose in the future following this. And some of it will be very fit for purpose. So we'll see a sort of polarized sector, I think, there.
Okay. And just looking also at the hotels and leisure, which has obviously had a significant knock during this period. What's our sense of that, both short term and long term, in terms of the prospects? Tony, I don't know if you're investing much in that area, but what's your general view?
Yeah, no, we invested in those sectors, in significant numbers around the world. I think obviously at the moment, it's one of the hardest, alongside retail, hospitality is the hardest hit sector, for obvious reasons, which everyone will be aware of. But I think that it's slightly different to retail in the sense that retail's also got a structural change of online, which has a greater or lesser effect everywhere around the world. But I think that hospitality is a bit different, because the reality is that people crave experience. And I think probably coming out of COVID, they're going to crave experience even more, because let's face it, there's not many great experiences going around at the moment. So I think that the demand for experience will continue to be strong. And that's a structural shift around the world. And therefore that leads to hospitality, including hotels, in the long run. And in the next couple of years, it's going to be very difficult, clearly. But longer term, I think that there'll be a resumption of strong activity around those types of those sectors. Maybe business travel might be a bit less. I think business travel, particularly because of the environmental concerns around air travel, etc., there may be a bit less international air travel for business people. But tourism, I think in particular, and I think you can't underestimate the rise in wealth in the Far East, in particular China. And also only a couple of years ago, the state introduced 2-week paid holidays for the first time in China. That sort of thing has an absolutely massive impact over the long term in the propensity of people to travel from China to other parts of the world. And places like London and other parts of Europe are very attractive in that regard. So I think that we will see a bounce back, maybe in a way that we won't see a bounce back in retail. I think we will see a bounce back in the hospitality sector generally. And I think investment demand will reflect that. And coming back to your earlier point about healthcare and other alternatives, I think if you take the lead from the US, where typical US pension fund investors would probably have over a third of their portfolio in the non-traditional core sectors of retail, offices and industrial logistics, up to about a third. Well, that's resi, but it's other sectors as well. I think what we're seeing is that demand for investors is becoming less for retail, obviously more for logistics, but also for these other sectors, which we'd classify as real estate alternatives. Most of them are quite small in their own right. They're quite niche. But I think aggregate demand over time is only going to increase as demand from investors for things like retail declines. So I think overall, in the long run, we'll see these sectors becoming much more mainstream. But the reality is at the moment, they're pretty small in the overall scheme of things.
I picked up, just something that was brought up on Realcast this week when we were recording that, related to the Brexit side, which was that if VAT for international visitors is removed, then that might have big knock-on effects for both the West End in terms of retail, but also other tourist destinations, and that was particularly around Bicester Village and value retail. Are there any other things that anybody else sees? I mean, Mark, you're probably looking at these regulations a little more in detail. Anything from Brexit that we sort of know about that we think might influence things, as opposed to just sort of things that we guess where we really don't know what's going to happen anyway about it until we get to slightly later on? Are there any particular things that you're seeing at the moment, Mark, that might have an influence?
I honestly don't think that there are. I think the wider point, and I thought, Tony made it very, very clearly earlier, but I think it's really interesting to try and work out when a new normal emerges, what things will have changed and which won't have changed. And I think the hotel leisure, the craving of experience, absolutely agree with that. And, unless you think that we're going through a societal change that means that we won't want to eat out, that we won't want to go on skiing, golfing, cycling, whatever breaks they may be, that we won't want to go and get to the sun on a cheap flight, then really it becomes about this interim period and holding the baby through the interim period. You know, we did a major disposal for Manchester Airport Groups to Columbia Threadneedle. You know, the view there, I think, you know, the airport group, which owns East Midlands and Stansted, in addition to Manchester Airport, you know, is trading at 85% down on volumes at the moment. If you thought that was going to be the case in 10 years' time, you'd shut up shop. You know, the reality is that the judgment is that passenger volumes will have recovered by 2024 at the latest. So it's that kind of sorting wheat from chaff that I think we need to do. And I think it's on that basis that you probably feel relatively longer term relaxed about hotel and leisure, but you may feel differently about conventional into style retail.
We've only got a couple of minutes left, so I just wanted to ask a last kind of question to everybody, which is just in terms of the opportunities. So you can pick an opportunity that you see at the moment for the UK market, and if you like, you can tell us why, or if you want to keep that secret to yourself so that you can make the most of that investment opportunity, feel free to. But let's start with you, Tony. What are you seeing at the moment as some of the kind of key opportunities here in the market for the UK?
I think the way to answer that is that when most people are looking left, it often pays to look right. At the moment, in a risk-off environment, nobody, very few investors are looking at pricing in risk of assets. And I think for us, and we're actually doing this, buying well-located London offices, which maybe have a bit of risk in terms of the tenant profile, lease expiry, etc. While everybody else is looking away, that's the place to take a little bit of risk. As long as you can ride through the short-term uncertainty of the next couple of years, where rents might get a bit softer and incentives might increase a bit. But to my mind, well-located London offices with a bit of risk on a relative value basis compared to other capital cities around the world is definitely a place where we're going to be investing money.
Okay, great. Mark, what's your sense of it?
We lawyers aren't as disconnected as I thought. I mean, I would absolutely have said, work and activity, not a place. I think best-in-class officers, whether in London or regionally, accepting that people will take less space but different space and perhaps want it to be more representative, more brand aligned, to say more about them and their operations. So I think that's where opportunity potentially lies. And, we have seen Landsec dispose 7 Soho Square. We've seen Suntec come in for phase 1 over Victoria. I think Tony's absolutely right. That is where I would have gone as well.
Okay, good. Steph, is that where you're going, or are you going somewhere else?
Well, maybe I won't pick on a sector per se. We have kind of briefly picked up on the ESG bit. I think we can't just take our eyes off that in the current time, although perhaps we're grappling with other things. The money is still looking in that space. You only have to look at the retail funds. You only have to look at what young, wealthy people want to invest in, and that is very much there. So, and also regulatory, if we look at things like biodiversity net gain, that's all coming through on the regulations as well. So don't ignore the ESG, and it's all about the operating income. We've said several times now that we can't kind of just look at income in its most vanilla form. We need to understand what's behind it.
Okay, that's great. We've finished exactly on time, so thank you very much for that. There's another session tomorrow, which is at 12 o'clock European time, 11 o'clock UK time, which is looking at how much of what and where, which is asset allocation in the investment markets, and that's looking pan-European. So please do join us for that if you're able to. That's another one of these that was originally scheduled for Munich. Thanks very much for sharing your views, Tony, Mark and Steph. Really interesting discussion. Thank you for joining us, and look forward to seeing you at the next one. Thanks very much.